There is an old and slightly cruel lesson embedded in every market crash, and it is this: certainty is a luxury markets rarely permit anyone to keep for long. 2 weeks ago, silver traders were writing eulogies. The metal had slid to a 7-month low near $55, and the commentary had that particular smugness reserved for people who mistake a correction for a verdict. Then a Thursday jobs report arrived, and the eulogy got interrupted mid-sentence. I'm John, and if you know this channel, you know I don't deal in sound bites. So let's build this the way it deserves to be built. Carefully, with the numbers in their proper order, because there is considerably more happening beneath this bounce than a single headline can carry. Start with the report itself, because it is, without exaggeration, one of the more startling misses of the year. The U.S. economy added just 57,000 jobs in June. Economists had penciled in something closer to 110 to 115,000. That is not a near miss. That is less than half of consensus, the kind of gap that makes a room full of professional forecasters quietly reach for their coffee and reconsider their whole model of the world. And here is the detail almost nobody bothered to explain properly when it broke. April and May were not merely soft in hindsight. They were revised downward by a combined 74,000 jobs. 3 consecutive months, quietly deteriorating beneath a labor market that everyone had assumed was simply fine. Unemployment, meanwhile, ticked down to 4.2%, a genuinely strange pairing, cooling job creation alongside a falling jobless rate, and precisely the kind of contradiction that splits opinion inside the Federal Reserve itself, because the committee does not yet have a unified reading of what this data actually means. Markets, it turns out, tolerate bad news reasonably well. What they cannot stand is ambiguity. Here is the mechanism, and I want you to actually understand it rather than simply nod along, because this is the whole hinge of the story. Silver pays you nothing for the privilege of holding it. No dividend, no coupon, nothing but the metal itself. So when a weak jobs report lowers the odds of the Federal Reserve raising rates, the opportunity cost of sitting in a non-yielding asset like silver falls right alongside it. Within hours of the report crossing the wire, odds of a rate hike at this month's meeting fell under 30%. September's hike odds slid from roughly 67% down toward 50%, essentially a coin flip now, rewritten in an afternoon off one data release. The dollar softened at the same time, heading for one of its worst weekly declines since April, which stacks a second tailwind directly on top of the first, not as some separate coincidence, but as part of the same mechanical chain reaction. So what did price actually do? Silver, sitting in the high 50s before the report, jumped sharply within the first hour of trading and broke back above $60 almost immediately. By the end of last week, it was trading near $62 to $63 an ounce, and as of this morning, it is holding right around $62.90, up more than 60% from where it sat this time last year. Gold moved in lockstep, climbing over 1% to trade above $4,180 an ounce. 2 metals, 1 signal, moving together the way they do when the story is genuinely about rates and the dollar rather than isolated speculation in one corner of the market. Now here is the number that ought to stop you cold if you take this market seriously. Registered silver on COMEX, the physical metal sitting in approved vaults that is actually available for immediate delivery against a futures contract, sits at roughly 93 million ounces as of the most recent reading, up meaningfully over the past month. Total combined registered and eligible stocks sit near 323 million ounces. Sit with those two figures side by side for a moment. The metal backing this market did not shrink during the crash to $55. It grew. That is not what a market running out of silver looks like. That is a market where the physical side was quietly repositioning itself, while the paper price, up on the screen, was telling an entirely different story to everyone watching only the ticker. Let's slow down on that COMEX figure, because most channels throw it at you without ever explaining why the distinction matters. Registered metal and eligible metal are 2 very different categories, sitting in the same buildings, meeting the same purity standard, but occupying entirely different legal status. Registered metal has already been certified and warranted. It can be delivered against a futures contract today, immediately, no further steps required. Eligible metal meets the exchange's specifications but has not been formally warranted, so it cannot move against a delivery notice until its owner takes that extra administrative step. When registered stock climbs the way it just did, from roughly 82 million ounces during the worst of the crash toward 93 million now, while the combined total barely moves, that tells you metal is being actively converted from eligible into registered status. Owners of that silver made more of it deliverable at precisely the moment the price was falling apart on paper, not less. That is not the behavior of people who believed the bottom was actually falling out of this market. It is worth pausing on that detail alone before you decide what this bounce actually means. There is a certain irony that history seems to enjoy repeating. The crowd panics loudest exactly when the people closest to the physical metal are quietly getting more organized, not less. Now, timing, and this is the part that gets flattened into a headline everywhere else. So let's actually walk through it properly, because the sequence here is genuinely unusual. The jobs report hit the wire Thursday morning before the New York Open. Silver's initial spike, that sharp move through $60, happened in the first hour of trading. Then, because Friday was a shortened pre-holiday session heading into the 4th of July, and the 4th itself was a full closure, this entire reaction sat frozen in place for nearly 48 hours. No new catalyst, no fresh data, just positioning, sitting there untouched, while most of the desk was off enjoying the holiday. A market rarely gets handed a shock catalyst, and then given 2 full trading days to sit with it in silence before anyone can react further. When New York reopens in the hours ahead, that frozen positioning finally meets live order flow again for the first time. And here is what is worth knowing before that open happens. While Western markets sat dark, Shanghai kept trading. Physical silver premiums on the Shanghai Gold Exchange have continued holding a real premium over the London and New York paper price through this entire stretch, a signal that buyers in the world's largest physical consuming market were not selling into this rally. They were still paying up for real metal while paper price was working through the shock of the jobs report on the other side of the planet. When your largest physical hub refuses to discount alongside a paper move, that tells you something important about which side of this trade actually believes the story it's being told. There is also a mechanical piece worth understanding, because it explains why the move happened as fast as it did once it started. Heading into the jobs report, there was meaningful short positioning built up in silver futures, essentially bets that price would keep drifting lower after the crash to $55. A lot of those short positions carried stop-loss orders sitting just above the market, protection against exactly this kind of surprise. The moment silver broke through $60 and kept climbing, those stops began triggering one after another, forcing short sellers to buy back their positions at a loss simply to exit. That kind of forced buying does not care about fundamentals or jobs data. It is purely mechanical. But it adds genuine fuel on top of whatever organic buying already arrived off the report itself. Old sellers getting run out of the building at the same moment new buyers were walking in the front door. None of this is happening in a vacuum, and if you have only been watching the labor data, you are missing half the board. Brent crude has slipped to around $71 to $72 a barrel, its lowest level in months, as shipping through the Strait of Hormuz continues recovering and hopes build for a more durable peace arrangement in the region. Hopes reinforced just this weekend by OPEC Plus agreeing to lift production targets further into August. Falling oil usually signals easing geopolitical risk draining out of the entire commodity complex, which typically works against safe haven demand for metals. But silver did not fall with oil this week. It rallied anyway. That divergence is, in a sense, the real story. When a safe haven metal climbs while the war premium is draining out of oil at the same time, it tells you this move is being driven by something structurally different. The rate story and the dollar, not fear. Before I go further, I want to know what you're actually holding walking into this open, because the setup looks different depending on what's sitting in your portfolio right now, and I read every comment on this channel personally. But before that, if this breakdown is actually giving you the fuller picture instead of the 15-second version everywhere else, hit subscribe and turn the bell on right now. I mean that sincerely. This channel exists because people who wanted more than a headline kept showing up, and the next jobs print, the next Fed meeting, and whatever comes out of Shanghai and COMEX this week are all still in motion. You do not want to be the person who finds out a day late what everyone who subscribed already knew this morning. Layer the deficit story on top of everything else because it has not gone anywhere, and it is not going anywhere next month either. This marks the 6th consecutive year that global silver demand has outrun mine supply, with the projected gap sitting near 46 million ounces for this year alone. That gap is not being closed by a jobs report or a peace deal in the Middle East. It is coming from solar panel manufacturing, from electric vehicle production, and increasingly from the physical silver load inside AI data center infrastructure, demand sources that do not particularly care what the Fed does next month. Here is something that should genuinely trouble anyone who sold near $55 2 weeks ago. Nothing about that deficit changed during the crash. Solar demand did not soften. EV production did not stall. Data center build-out did not pause. What moved was sentiment, driven by an entirely separate set of headlines that had nothing to do with silver's actual fundamentals. And sentiment, unlike a structural deficit, can reverse violently the moment the right data print lands, which is precisely what just happened. There is a small footnote worth adding here, because the oil story touches silver through more than just the safe haven channel. Cheaper oil lowers input costs for mining and refining operations, which on the margin makes it slightly easier for producers to keep supply flowing even at today's elevated prices. That is a modest factor compared with the deficit story, but it is part of why you should not read falling oil as automatically bearish for silver. In this case, it is arguably a mixed signal, easing the war premium with one hand, while quietly supporting the supply side of the ledger with the other. Let's talk honestly about what happens if this move does not hold, because I am not here to give you only the bullish half of a story that deserves both halves. A single jobs report is backward-looking data. It tells you what happened last month, not what is guaranteed to happen next. If July's employment number comes in hot, a meaningful share of this rate cut repricing unwinds fast, and silver can give back a real chunk of this move just as quickly as it built. The algorithms trading this market do not care about conviction. They care about the next data point, and the next one is always coming. But here's the distinction that actually matters over the long run, and it is the same lesson this metal keeps teaching over and over to anyone patient enough to notice. There is a difference between a move driven by sentiment and a move driven by fundamentals. The crash to $55 was sentiment, headlines that had nothing to do with silver's actual supply and demand. This bounce is partly sentiment too, a single data print, a holiday liquidity vacuum, a wave of forced short covering. But sitting underneath both of those moves, entirely unmoved by either one, is a 6-year structural deficit and a COMEX vault that has been rebuilding rather than draining. That is the part that does not reverse with next month's jobs number, whatever it turns out to say. It is worth stepping back and putting this whole episode in a slightly larger frame, the way a historian might rather than a headline writer. Markets, like nations, tend to overcorrect in both directions before finding something resembling their true level. Silver's crash to a 7-month low was an overcorrection to the downside, built on a set of geopolitical headlines that had nothing whatsoever to do with the metal's own arithmetic of supply and demand. This bounce may well be a partial overcorrection in the other direction, accelerated by holiday illiquidity and forced buying from traders who never wanted to own silver at these prices in the first place. Somewhere between those two overreactions sits whatever silver is actually worth today, and the honest answer is that nobody, including me, gets to know that number in advance. What we can know, and what the data actually supports, is the shape of the underlying structure, a deficit now in its 6th consecutive year, a vault that has been quietly adding registered metal rather than shedding it, and a physical market in Shanghai that never once discounted alongside the panic in the West. There is also a question worth asking honestly, the kind George Will himself might pose with a raised eyebrow. Why does a metal with such a clear structural deficit keep getting priced, again and again, as though that deficit does not exist? Part of the answer is that paper markets and physical markets are not the same market, however much the ticker likes to pretend otherwise. Paper silver moves on jobs reports, Fed odds, and dollar index candles. Physical silver moves on solar installations, EV production lines, and data center buildouts that do not check the calendar for the next FOMC meeting. Most of the time, those two markets drift along together closely enough that nobody bothers to distinguish them. Occasionally, and this looks like one of those occasions, they diverge sharply enough that the divergence itself becomes the story. Tomorrow, once New York has actually opened and we can watch this reaction tested against live order flow for the first time, I am going to walk through exactly what that first full session looks like, whether those stops kept firing, whether Shanghai's premium held, and what the vault numbers do next. This is a story still being written in real time, and tomorrow's session is going to answer a great many of the questions this video just raised. Before you go, I want your honest read on this right now in the comments. Tell me exactly what you are holding walking into this open. ETF shares, physical bars and coins, mining stocks, or cash on the sidelines watching all of this unfold. I want every single type of holder represented in that comment section because the setup genuinely looks different depending on what you actually own. And I read every single comment on this channel myself. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.